Hello, this is Cynthia Fick, and this is the January 17th, 2023 stock market update. So I'm going to keep today's video short and sweet, and let's just go straight to looking at some graphs and some charts. Here we go. Okay, so last week we talked about just how bad 2022 had been, and said basically that for the combination of stocks and bonds, 2022 was the worst market we've had since 1871. And here's one of the reasons why. In all these different corrections that we've had in the past, going back to March of 2000 on into 2002, the S&P was down 49%, but bonds, this is the 20-year treasury, this is the 10-year treasury, and this is gold. There were places to hide. Stocks were going down, but you could have gotten into some bond funds and maybe some gold and done pretty well, still made some money. Same thing in 2007 to 2009, the correction we had then, the S&P 500 was down 56%. But again, there was a place to hide. You could buy some of these 20-year bonds, 10-year bonds, or gold and still have made some money. Well, welcome to 2022. Again, the S&P 500 was down around 20%. Couldn't hide out in long-term bonds. They were down almost 30% themselves. And then even medium-term bonds were down 14 some odd percent, and gold did very little also. So that's how bad, again, 2022 was for both the stock and the bond market. Worst year for both of them combined since 1871, and the average stock being down about 35%. So let's go on and say, I also said at the end of last week's video that there was some reason to hope that some of the fundamentals of the stock market seem to be shifting, and the stock market seems to be thinking maybe inflation has peaked, and maybe we will they'll start to lessen the raising of the interest rates, and that we're going to have a soft landing in the economy. And so something internally has started to shift. We'll see if it has legs. Again, I'm waiting, watching, have to keep an open mind. I said earlier, I wouldn't be surprised if we do go into recession that, this market could wait until April, May this year to bottom out. But it looks to me like that could be changing. We at least have to keep an open mind. And here's a chart of the S&P 500 going way back to 2006. All the way to today, and we're coming into a very long-term trend line where historically, we're holding above it, which is another positive. And then, not sure again whether it's going to be tomorrow, whether it's going to be in February when the Federal Reserve meets next, or whether it is going to be later in the year, April to May. Here's what it looks like when we've had significant lows. This is going back to 1970 when we have some significant lows. Shows us where the S&P 500 usually is 1 year past that low, 2 years past that low, 3 years past that low. So you can see these are the dates where we had significant lows. So 1 year from that time, the S&P was up 43%. 2 years later, up 59, and 3 years later, up 55. So again, these are all green, which means making money and go, 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 not stop, stop, stop. So this is an average here. The average S&P 500 return after a major low is 1 year later, 37%, 2 years later, 59, and 3 years later, 72. So don't know when it's going to happen, but at some point, things should start looking better after this kind of major worst year since 1871 that we've just had. So let's have some, hopeful positivity, and we'll let the market show us if we have reason to feel that way. So have a great week, and we will see you next Tuesday. Bye-bye.